Srikanth says, in this volatile market, I am considering buying 2 at-the-money SPY puts 120 days out and selling 3 out-of-the-money puts 2 weeks to expiration. Oh, I'm sorry, 30-day out, 30 delta puts 2 weeks to expiration. Could you help analyze this strategy? Okay, so you're doing a calendar put spread is really all this is. It's just that the bought call is at the bought put, Srikanth, is at the money instead of slightly in the money, which I would normally prefer to use. And it's a ratio. So that's all you're doing. It's a ratio calendar put spread, to put it simply. And it's going to be a bearish position with a bullish twist. Is the one way to describe it. So let's go ahead and take a look here. 120 days out on SPY. We're going to be looking at April. We're going to be looking at June. Let's just take April, Srikanth, for the time being, close enough to 120. And today, the at-the-money put, we're at 385. I'm sorry, I almost said 305. 385. Or is it 380? Let's just use the 385 for the time being. Now, I don't have delta here, but that's okay. We're gonna eyeball it. I'm sorry, you said 2 weeks out, 14 days. Great. 11 days, January 10th. Would it be the 11th? Oh, no, I'm sorry. 13th. Okay, great. Now that I have my mindset looking at the daily options, it's harder for me to see that. But 0.3 delta, I'm assuming the 370. Might be a little bit too low for 2 weeks out. Yeah, it's only 2 weeks out. All right, so let's take a look here. What are we doing? We're going to buy 2 of the at-the-money April strikes and sell 3. Here, 0.3 delta. Okay, just clear this up a little bit. Let's just call this 1821, and let's call this 215. All right. Okay, great. So why did I say that this is a bearish strategy with a bullish twist? A calendar put spread, if I had just bought 2 of the at-the-money, and I could argue that 380 was closer, but it's since that far out in time, it only gives us the 5-point strike difference in those cases. 382.43 is right in the middle. So we might have actually been buying the 382.50 if it was available. That's what we target. You could use the 380. We use the 385. Okay. Where I'm going with this, Srikanth, is if we just did a standard calendar put spread, buying the at the money, slightly in the money 385 puts and selling the 370, we'd have a profit and loss chart that looked like this. A bearish sort of calendar put spread. Loss is to the upside because that's where we paid the debit, and our long puts would be decreasing in value if the stock moved up. Peak is right at the short put strike prices, same as we see here. But then we have a tail off that probably didn't dip back below into the loss area. Now that you've added the extra put, it gives you slightly more of a bullish skew, meaning this break even here of 387.46, let me jot this down, and 359.88 is the lower break even. In this ratio spread, you probably moved this up from the standard calendar put spread because of the extra premium on the 3 sold to 2 bought ratio. It still gives you 2 ways to lose at the shorter term expiration. Only 5 points away to the upside. These are not your numbers. I get it. I understand that, Srikanth. But again, just looking at the numbers today for a strategy longer term, okay? You still have 2 ways to lose on the position. What makes me nervous about this is if the patterns of 2022 continue into 2023. Swinging wild up and down. Of course, you're going to have ways to manage it. You're trying to apply a delta neutral position. In that case, and you're going to try to manage it as the stock, the underlying security SPY, moves up and down. Srikanth, I get it. But the structure itself, to me, just looking at the graph, you know what I'm going to say is that this is designed for neutral to bullish positions. In a 2-week time period, would I say it would be out of bounds for SPY to move up 5 points? Not at all. Would I say, another 10% decline in 2 weeks of SPY? Not quite 10, but down 30 points, maybe 7.5%, 8% in a 2-week time period. In a normal market, I'd say that might be a little bit out of bounds. That might be a little bit unexpected. Coming off the market of 2022, anything is possible. This is highly possible. This is possible. You're going to have to be on your toes to manage the position. And one thing that you've heard me say before is that the allure of delta neutral positions, where the 3 delta sold at minus 0.30, and I don't even know if I have the right structure there, and you're at the money puts 2 at a delta of, let's say, 50. Mine would probably be about 0.52, 0.53, but you're looking at doing the at the money delta of 50, buying, so it's negative, and selling 3 at 30. So overall, you have a negative delta of 1 with the at the money 2 bought puts, and a positive delta because you sold the premium here, and it's a negative delta, but a positive delta of 0.90 overall on the 3 shorts. So you're trying to get close to a 1-to-1 delta neutral position. And as the stock fluctuates, you're going to be managing 1 or 2 of the short puts or 1 or 2 of the long puts as it moves up, or moving these 1 or 2 up in those cases. One of the reasons why you don't hear me talk a lot about delta neutral positions, theta neutral positions, is because it's a lot of work to consistently move and adjust the positions to keep near this delta neutral status on the trade, to try to keep the profits within lines of the target goals. Honestly, I don't have that much time during the day. When I retire, and I'm not doing a lot of videos, webinars, coaching sessions, phone calls, Srikanth, I'm going to start expanding, honestly, my different structures. I'm going to start looking at different strategies that are more time consuming, depending on what my wife allows me to do when and if retirement happens. Well, I should say if, but when retirement happens. But for now, even though I'm on the computer all day, even though I have power options open in front of me, I likely have 1 or 2 of my trading accounts open in front of me, I'm not actively trading, and doing the delta neutral things for me personally is too time consuming and takes too often to watch. But if you're a trader and you're not day trading at all, Srikanth, that's not what I'm saying, but if you're trading during the day regularly with multiple adjustments, shorter term positions, then yeah, this is what you're looking at here. I had a coaching session earlier this week related to spread positions and iron condors. An investor wanted to know what settings they should be using for an iron condor because they were not having any luck in the past 3 months trading iron condor, or it was 2.5 months, my apologies, trading iron condor positions. They were getting a lot of losses. Thankfully, many of them were paper trades, but a lot of them were, some of them, about 40% of the positions that he had open in the portfolio were real trades that lost money. And just looking at SPY, you can see why. An iron condor position, what is it? It's a combination of a bull put credit spread and a bear call credit spread on the same security with the same expiration date. Now, this might not look like wide movements, but we're going from 390 down to 375, up to 405, down to 375, then to mid-range. With swings going up here as well that were pretty quick, all the way down to 350. That's just in the last 3 months, the last 90 days. This is not the movement you want to see in the market for an iron condor position, regardless of the implied volatility, giving you a little bit better oomph perhaps in certain cycles than you would have seen the cycle before. It's a neutral position. You don't have a low risk, you have a known risk. And again, just as I mentioned, if you don't have the proper management, say the 1% rule or other things like that, before you know it, you're taking large losses here, which might be wiping out 5 to 7 to maybe even 10 previous successes from a credit spread or an iron condor position. In short, the customer asked me, well, when is a good time to do the iron condor positions? It's when the market is as neutral can be. Now, that's the double-edged sword, isn't it? Because with that iron condor structure, if the market's as neutral can be, we're going to be losing volatility, so you're not going to be seeing as high premiums. Earlier this year, we were talking about, is it possible to make 3% per month? We had a series of webinars there, and we talked about how even up until September, where are we here? It was going up to September, doing just a bull put credit spread approach with an 85% probability or higher would have had your portfolio, or that portion of your portfolio, down 86% of what you started with. But even doing bear call credit spreads, high probability, 85% at this time on downtrending positions, still would have been down about 19 or 20%, I believe. What we had to do is move with the market and shift. And we used the market sentiment tool that when we saw a strong buy, we went from bearish to bullish. Then we saw the bear signals. We moved into bearish spreads, back to bullish, then went into bearish, back to bullish. And we were bullish in this hiccup, which hurt. I think it was there. Maybe it was further down the line. No, it was here. I'm sorry. We were bullish in this trend, and then that happened. Went to the bearish, back to the bullish. On around August 15th is when we started seeing the signals for the bullish buy again. So on and so forth. You had to move with the market. But if I'm losing on bear call credit spreads on these upswings, and I'm actually losing on bull put credit spreads on the downswings, even this big one here, big sudden movement there, Powell comments, I believe, on an iron condor, you're losing on both ends of the candle. You're still losing on the bear calls in the upturn, and you're losing on the bull puts, and you only gained an extra 20 or 30 cents with the extra spread as a hedge. What you typically want to see for an iron condor is more along the lines of the melt up that we saw in most or part of 2021. Let's go to just 1/4/2021 and 12/30 of 2021. This was still kind of risky in this case, but this is what we call the melt up. Gradual movement up with a little bit of hiccup. Movement up with a little bit of hiccup. Stabilized, movement up, a little bit of hiccup. This isn't the best scenario. Here you probably would have been managing bear calls. Then a little bit of a lull. Maybe had to manage the bull puts here. Then this little stable, up, little hiccup, maybe a little bit of management. More stable, a little bit of management. But this is the time frame. Not so much this, but this would have hurt you here. This might have been managing bear calls, but those areas here, here, that's what you want to see. Maybe even here is what you want to see for an iron condor position, not what we saw in 2022. Why am I going off on this tangent when I made a promise that I would stay on task and dot all the I's and cross all the T's? Is because the delta neutral positions, ratio calendar spreads, things of this nature are similar in the aspect to a butterfly and a condor, that they're neutral positions. You have an upper and lower break even that are going to need to be managed in those cases as the stock starts to swing one direction or the other, especially if you're trying to keep delta neutral as a hedge on the position, which Srikanth agrees it's a high maintenance strategy. Absolutely. Not for the faint of heart, and not for those who don't want to spend all their time necessarily trading or watching the markets or listening for the alerts on their phone or on their computer from the brokerage. Excuse me, folks. So that's my concern. Main concern, Srikanth, is the time that it takes for these trades, the neutralness of these trades still coming off of the market that we've seen. We haven't really determined a pattern for 2023 yet, of course, but we've seen some relaxation of the negativity. As I mentioned, it feels like the market is taking a breath. It's sort of stepping back from the economic fears and the economic discussion and fears of a recession. So maybe we'll see some good stabilization in this case. I get what you're doing. I see what you're doing. You can clearly tell it's not something I can actively do. I was honest about that. The one other thing I don't want to say is a concern, because you're covering it with the premium for the 3-to-2 ratio, but as always, I talk about the at the money bell curve. And we usually talk about that. Let me redraw that there. I'm going to change color too. We talk about the at the money bell curve a lot related to the married put positions. The at the money bell curve, you look at any option series, whether you're out to April, whether you're buying 2 weeks out, whether you're buying a leap, 400, 500 days out in time. You look at the option chain for calls and puts, and the options that are closest to the stock price are going to be here. They're going to have the highest time value, which usually what that dictates to us is that this is where we want to be selling in general to get the best time value decay. And when we're buying calls or puts, we want to be buying slightly outside on the wing, slightly in the money or slightly out of the money as a general rule. Now, that being said, you're buying properly, as we would for a married put approach. You're buying 120, 112, 150 days out in time, which means your time decay curve, even though you're buying into the highest time value, it's going to be more shallow. This is 30 days to your expiration date. This is 60, maybe it's a little bit higher. The cusp here is around 90 or 100. This is 120. Period B around 150, and 180 back here. So even though you paid into the higher extrinsic or time value, you're starting to see the lower decay in that first quadrant, and you're generating premium against it to lower the cost basis and negate that time value. But that is a concern when I see buying at the money options. It's just knowing that you're paying into the highest time value for that expiration at that time. And time value works against you as the option buyer, but you're minimizing that, of course, by selling, and not just selling 3 more than that which you'd bought in those cases. So that's just another little concern. What really concerns me, stands out to me, is the neutralness of the trade. Even though you have a trading plan in mind, Srikanth, you're looking to manage it based on the delta. You have the 3-to-2 ratio in place that you're going to use to manipulate. Hopefully, you get that stabilization or even a movement up so that you can maybe buy one of these back and adjust the other two to get a premium and further lower the cost basis. What would that do? Move this break even up and potentially even move this break even down. Depending on the strike selection, it might move this break even up as SPY is stabilizing or moving up. And that's what you're shooting for. And of course, as we saw with Kenneth's position, the discussion on the 2 week or 1 week out naked put for Tesla, with the extra day in place for this position, you're going to see some extra time decay on the 2 week out as well as the 1 week out. So that'll be working in your favor come Tuesday morning also.